All right, so a simple trade. Try to do one of these every month. Normally, I'm in a morning stream, and I would already have pointed it out. So I usually let the first week go by. It's kind of a little bit of a routine. We were, in the shorter part of the week last week, so got through the weekend. We're now into the new month, and the idea is a monthly subscription at the Bullish Bears is around $50 a month. So we want to put on a trade that could generate at least $50 in that 1 month time frame. And then you would just kind of allocate in your mind that that money covers the cost of your subscription. Obviously, there's nothing different from this trade than from doing anything else, right? If you had bought a call or whatever, bought some stock and made $50 and set that 50 aside and said, well, that's going to be for my subscription, then it would just be the same thing, right? What you'll find when you're trying to cover the cost of your bills and you are now responsible for everything, that you don't go to a day job anymore, that you're covering everything with your trading, that it helps to put trades on specifically to pay for particular things, right? Like, well, there's a car payment, there's a house payment, there's my Netflix subscription, whatever it is. So this is a pretty basic trade. It leans on the sell side of things. If you're unfamiliar with options and you don't understand why we're using the sell side, think of it as the difference between trading something that has to move versus trading something that doesn't need to do anything. Obviously, if you are taking a trade that does not require the market to do something, it's going to be easier to win that trade than thinking the market is going to go to a particular spot at a particular destination within a particular time frame. So for an example, we're looking at SPY. I'm going to flip this over to the MES. This is the micro futures. And if we were looking at this and we wanted to ask a basic question like, do you think we are going to stay below 4,700 for at least most of the year? I would say that's a pretty safe bet, right? Could we go to 4,700? Yeah, shoot, absolutely, we could go all the way up there. Do you think we're going to get there in the next 4 months? Yeah, probably not, right? And even if we did, there's a trade that we could do to manage that, right? We could take our trade that we're going to have on and we could do something with it. So what about 4,800? Do you think we could get to 48? Right now, obviously, when you're putting on a trade like this, the closer you get to money, the more money you're going to get, because the way the options work, very fair and very balanced. If you take risk, you have the potential to make more money. If you take a trade with less risk, you get less potential for money, right? That's a fair and balanced world. Newer traders often miss this subtle point. They want to find the safest thing out there with the highest probable win rate. And then, of course, they make pennies while risking hundreds of dollars to do it. And as soon as they get one losing trade, it wipes them out and they can't understand why. Take risk. To take a risk often means that you get to put less money up and you will make a lot more money in return. So to figure out which trade we're going to put on, let's just go look at some prices. That's usually a great place to start. A lot of newer options traders think that there's something special in those Greeks. And if they could just figure out how to read the Greeks just the right way with enough background and experience, then they would be picking the perfect or correct strikes all the time. That's not the way it works. There's nothing in here that stands out and says, well, I picked that strike because the theta was at X level and the delta was at this level and it had this much gamma in it. Nope. But you could look at how much money you could make when you choose that strike, right? So right now we're looking at around 100 days out. That's the September 16, the U series. And right now we're on the M's. The M's have like 10 days left and they're going to be gone. So we may as well just already choose the next series out. With 100 days to go, this orange bar here represents the distance of the expected move. This platform is saying that within now and the next 100 days, the S&P could move an entirety of 800 points, 400 points higher and or 400 points lower from our current location, right? Think about a circle and the difference between the radius and the diameter, right? And for any of you who don't speak nerd, just think about the middle of the circle, right? So if we want to build a trade beyond the boundaries of what's expected, then we would want to go at least as far as this orange bar. And if you're not familiar with options, the left side is the calls, the right side is the puts. And I will point out, look at the lack of volume in this thing. Notice, for an example, that there's nobody trading in here. So if we're going to put the trade on, it will be a struggle. We're going to have to work the order, try to get filled, try to get filled, try to get filled. I point out this volume because if the volume looked like this on any of my normal options trades, I would not put the trade on. Volume is really important to options. The criteria usually says if it isn't liquid, I'm not trading it. However, the micro futures are still really new. So many people don't even know that these futures exist, let alone know that there are options on these futures that you can trade. So they will grow in popularity. They're just not really popular right now. And so this product gets an exception to the rules when it comes to my liquidity rules, but we still need to take some things into consideration. And that means we don't do complex spreads on here. And I don't mean that you found them complex. If we were using that criteria, then anything out there would be considered complex. The way that the industry describes it is if it has more than one leg, it is a complex trade. Some places say if it has more than two legs, it's a complex trade. So we don't do anything in here unless it's just a single leg. Now, depending on the liquidity, because when you get really, really close to expiration, these things have a lot more liquidity. You might want to consider doing things like a vertical or something like that. But for the most part, you want to keep it very simple. No butterflies, no irons, no verticals. You're just going to sell a call or you're going to sell a put. And that's that. If we get challenged, and that's really important to already have a plan in place. If we get challenged, what are we going to do with it? The simplest thing to do is buy an option. So if I decide that we're going, or that I'm going to sell this 4,400 strike call, and I start to get challenged, meaning price starts to run towards me, I need to know what I'm going to do with this trade. I don't want to use a stop, and I don't want to have some arbitrary number as a spot that it's going to kick me out at. But I do need to make a decision. What am I going to do with it? The simplest thing that I could do is just buy a call. I could buy it in the same series, or I could buy it farther out if there's somewhere farther out to go, which would turn this trade into like a calendar or a diagonal. But that would be the solution to the problem, and it would be a problem. So we're going to talk about the put side for a minute first, and then we'll circle back and talk about the calls, because I'm really thinking that selling a call right now would be the way to go. But let's just focus on the puts for a minute. If I sell this put, the 4,000 strike put, then I need price to stay above that put. That's simple enough. If price got below this put, it doesn't mean that I lose. I just need price to get back above that put before expiration. Now notice where it says max loss. It says that my max loss is $19,243. This is usually where everybody freaks out and says there's no way I'm risking $19,000 to make $750. You're not risking $19,000. The S&P would have to go to zero for you to lose that. Do you really think the S&P is going to go to zero? Has it ever in the history of the entirety of the marketplace ever gone to zero? And if it did, do you think that this one trade would be your problem? I would say no. Nuclear war could drop the market to zero, maybe. Or maybe if somebody blew up Washington, D.C. or knocked New York off the face of the earth, that might drop this to zero. Can't think of very many reasons that the S&P would ever go to zero without something as extreme as those things right there. So your max loss is not $19,000. Take a breath and relax, because the S&P won't go to zero. But when it comes to an option, if it is a high volatility market event, say when Russia invaded the Ukraine and everything got high volatility spikes, you could see this option gain $5,000. And if you was freaking out that your trade was losing and you closed it as a loser when it was down $5,000, then yeah, that's a real loss. But that's a volatility price. So even if the stock price, or in this case, the indexes, even if we're hovering around 4070 or 4080, if we dropped there really fast and volatility spiked up, the value of this option would spike up very high. And that tends to freak people out, because then your losses are looking really big. But as long as we didn't go beyond and to the downside of 4,000, you're not technically in a losing trade. You would just need to manage this trade. You would need to somehow shunt that volatility and the rising cost of that option. One of the ways that you could do that would be to buy another option, right? At which point you would be in some sort of a spread. Now, depending on which one you buy, you could turn your naked put into a put debit spread, or you could turn it into a put credit spread, meaning depending on if you think price is going to continue to go below 4,000 and keep going, you would probably want a debit spread. If you think we're just going to tickle that level, find support and rally away from it, then you're very likely going to want the put credit spread. Either way, adding that long put to this trade would solve the problem, because look at the buying power effect and look at the max loss. I fixed it. I don't have thousands of dollars that it says that I'm at risk now, because I'm covered. So should any of these trades get challenged, the simplest solution is just to buy a long option. That's important to realize if you're using a smaller account, right? Say you have a $5,000 account and you decide, hey, I'm going to do this trade because if I sell this put, it's only going to take $1,100 of buying power, and my $5,000 account could handle that. It could, until volatility spiked really big and suddenly you're getting a margin call and you got the broker on the phone saying, if you don't put money in your account, we're going to close that trade as a loser and you're going to eat that $5,000 loss. Yeah, no, we don't want that. All you have to do, buy a put. I know it seems counterintuitive, but if you buy a put, if you spend money, even when your account is heading towards a margin call like that, you will eliminate the margin call, because when you're trading the put naked, you have a very large amount of loss that it could take. And so your buying power effect will change due to volatility and price moves and everything else. So simple solution, if you're getting challenged, buy a put. Now you can always just close the trade. I'm going to add that, but we wouldn't want to do that, right? If this thing is suddenly down $900, I don't want to close that trade. I'm going to lose $900 and I don't want to lose $900. So I would just buy a put. That would also buy me time and allow the market to move around and shift around. Maybe the put that I buy eventually costs me a loss and I take, I don't know, $50, $70 of a loss. Fine, I don't like it, but I'll take it. That would still be better than eating thousands of dollars of loss, right? Now, that's not just a futures trade. That's options trading logic 101, right? So that's the put side. And it had a defined loss, 0. But when you sell a call, it doesn't have a defined loss because the market doesn't have a ceiling. It can go up and up forever and ever, amen. So it shows an unlimited max loss. Well, that also is a little bit of concern. Because at what point do we define that we've had enough? What's our max pain? I don't really have a max pain. I would just buy a call. Simple solution. If the market was to continue to rally towards us and we felt threatened, simple solution, buy a call. It's no longer a max loss or an unlimited loss trade. It would then at that point be capped in some way. And the call that you would choose to buy would either turn your trade into a call debit or a call credit. Now, if you're thinking to yourself, why are we even going to use the futures? I don't know anything about the futures. They seem a little weird. Their options don't reflect the kind of options values that I'm used to seeing. Why are we using these complicated things? You don't have to. You could use something like SPY and say we go 100 days out here. And I asked, do you think SPY could go to 700 in the next 101 days? No, I don't think so. Okay, let's sell the 700 put. Oh, I'm only going to get a penny? Come on, man. That ain't going to do it. And they would still require $4,100 of buying power for me to have the privilege of making that 1 penny. That ain't going to do it. Okay. Let's go back to the MES. You think the MES is going to go to 7,000 or 4,000 to 700? Let's see what we got out there. Yeah, 4,700 sounds good. Do you think that we're going to go there? No. Well, this trade would make us $40 and it has a buying power reduction of $525. Hey, 40 bucks, I know that's not very much, but we're talking about the S&P going to 4770 or maybe even to 4,800. Now, remember, we're talking about covering the cost of a $50 a month subscription. So we're not talking about putting on a trade that will make a house payment here. Let's go back and look at the MES. Where is 47 or 48,000? Oh, the yearly high. So we're basically saying you think the market will stay below 2022's high, at least for the next 100 days? Yep, that's kind of the bet. Now, granted, this trade isn't going to pay you very much, right? But look how far away from the market we are. And if you have the stomach for it, or you think you have the timing or the will, get closer, right? How about 4,700? Basically doubled the amount of profit you could make. Well, how about 46? Now we're looking at $100 and something. All right, so you're in full control here. You want to get closer? Get closer. It's not going to hurt anything. The expected move is 45.50. What if we were just to stay outside the boundaries of the expected move? We're looking at around $166 and a buying power of $792. And again, If we were to get challenged, which I don't see likely, but it's always possible, we could roll this trade. We don't even have to eat the trade, right? You don't have to necessarily just automatically buy a call. You can roll this call farther out in time. Say the market rallies and gets to 4,300, and we're a little concerned because it's kind of getting close. Well, at that point in time, all of these options will have gained in value, even the one that you sold. So you're down in that one, but everything is up. Everything has more value to it. So if you roll out in time and you sell another call, closing this one and opening the next one, and at that point, targeting a level higher than the all-time high of the year, maybe you sell the 49 or the 5,000, it would bide your time, solve your losing trade, and rebuild your position farther out. A solution to the problem, right? So simple. We only need to cover around $50 if we're going to run this thing all the way to expiration. If you're thinking, yeah, I'm going to open a trade and probably close it at around 50% profit, then we can open the trade targeting just around $100, right around in there. So we're looking at selling something around the 46.30 area. Now, if you're wondering why we're on the call side instead of on the put side, well, think about it like this. We've had a nice little rally off of these lows. We're now stalled out with the possibility that we could break to the upside and continue to run. That's true. And with the possibility that we could fall back down. If we were to sell a put, where would we go? 38, 37, 36. The trend is to the downside, and I don't want to stand in front of the trend. We're also looking at selling calls near the high of the year, and there is a lot of pivot points between the current stock price and the all-time high. So for this price to challenge our call, it has to get through all these pivot points. But if we put on the put, there's not so much between us and the current stock price. There's only like 2 pivots there. After that, it's going to come at us like a freight train. And I don't know about you, but I don't want to get run over, right? So that's the trade. You put this trade on and you allocate that capital to pay for your subscription. And next month you put on another one, even if this one isn't done yet, right? We just allocate into another one. Getting into the next one, we would yet again look at what's going on in the current market conditions, make a determination of, do we want to be on the call side or the put side? And we just keep adding to the trade, right? It's like, visually, think of it very similar to the chandelier indicator, or what do they call it? The trailing stop indicator. If we were looking at something like this trailing stop, and every time it shifted, we put on a new position, not that we would ever do such a thing, for goodness sakes, don't do this. But if that's what we were doing, then every one of these would represent another trade, right? That's kind of the concept that we're talking about. So commissions are always a difficult thing because each broker does something different, right? When it comes to Tasty, they kind of take the cake on simplicity. There's a number of things that I like about Tastyworks when it comes to commissions. One of them is the flat rate fee. So once you get past 10 legs, you're good to go, right? But we're talking about options on a micro futures contract. It's round trip, $1.50. $1.50, and then the fees, and then the exchange fees and the NFA fees. But still, it's around $2, right? Just like that. Simple, easy, not shady like Thinkorswim. Those guys are shady, man. They're like little crooks. But I'm not here to bash Thinkorswim. I could do that all day long. Oh yeah, man. They give no quarter over there when it comes to futures, whether we're talking futures or options on futures. They don't care. They straight up will tell you that's the way it is. You don't like it, suck it. Like, thanks, guys. That's not really professional. They don't care. They are very rude about it. We're not adjusting our prices. Fine, whatever. Now, when it comes to regular options, you can negotiate with them. So anybody who's trading on Thinkorswim outside of futures, if you're paying what you consider to be a high price for your options trades, reach out to them, argue with them, negotiate with them. They will drop your value. But with futures and futures options, they hold firm and they will not change, not even a little bit. I don't even want to argue with them. I just gave up on them a long time ago. This is a good trade, guys. Would I like have my entire account doing trades like this? No, heck no. No. But it's a good trade, even on a day or a week or a month where you really don't have anything going on and you really can't find any strong bias in the market. You can still do a trade like this. Yeah, the way they do it is they get the entire round trip in the open. But on Thinkorswim, they break the cost in half. And so you have your opening value and then you have your closing value, and they charge you fees on both sides of that. But Tasty just wraps it all up into one right up front. When it comes to regular options prices, Tasty and Thinkorswim, they're not very far apart on regular options for a round trip trade. Tasty just gets the whole thing up front. But what I really like about Tasty is the 10 lot. When I'm day trading, say I want to day trade SPY, and I just want to buy a call and run that thing like back up to the high here. If I buy 10 calls or 100 calls, my commissions stop at 10 calls. Man, I love that. So if you're going to size up, Tasty is your work. That gets it done. Because you cap out. And it doesn't even have to be naked options. You cap out on irons, butterflies. It doesn't matter. 10 lot, that's it. So you're talking about saving money. That saves money. All right. So at 1 o'clock today, we had the 3-year auction. And the 3-year auction was my line in the sand. I didn't want to get anything new opened. I didn't want to do anything until I seen how the market responded at 1 o'clock. We're past 1 o'clock and we did not dump. Now that doesn't mean we can't. We can get back up here to the high of the day and reject off of it and fall back down, but it won't be connected to the 3-year auction. It'll be just regular market mechanics, and that's fine. The concern was with them letting things expire on the balance sheet and reducing the balance sheet. These auctions that are coming up is kind of putting us in a position where we don't honestly know what's going to happen. And by we, I mean, like, they're talking about it on Bloomberg. They're going through it on the Wall Street Journal. They're asking all these executives and analysts, like, what do you think is going to happen? Well, gee, Bob, I don't know. We're talking about people who's been doing this for 50 years and they don't know. That's longer than I've been alive. Kind of close. If they've been doing it for this long and they ain't figured out what's going to happen with this balance sheet reduction, then we want to just stand aside, be prepared for a little bit of hanky panky. And it didn't happen, right? We're past 1 o'clock. The world didn't burn. We didn't have explosive moves to the upside or the downside. Everything is fine. Now we still have the 10-year and the 30-year this week. And this is only the 3-year. You know, it's a really upfront, really close bond. So we got to see how the other two are going to come out. But I didn't want to put a trade on like this kind of swing trade sitting on top of the market until we had the results from the 3-year. I would consider these results, right? We're past it. If we were going to see something, it would have happened. So let's get it. I need to swap accounts. This isn't the account that I want to use. So let me drag over the right account, which basically means log out of this one and log into the other one. Boom, boom, boom. All right, the other one. Now you don't have to use the micros depending on the size of your account and depending on your comfort level with options trading. So we're on the ES right here instead of the MES. Just for comparison purposes, if I was to sell the ES rather than the MES, what would be the benefit and what would I gain from that? Notice that there's actually volume on these. Whereas when we were looking at the MES, there was no volume. There was a little bit of open interest, but there wasn't really any volume. So these are more heavily traded. They've been around for a long time. So that's one thing. Cost-wise, what are we dealing with here? Now, when it comes to the ES, doing complex spreads, feel free. You've got the liquidity here for that. So in this one, if I was to sell the 4,800 strike call, it would be a $9,800 buying power reduction. And this is a retirement account, often considered a cash account. There's no margin to this. If I was on the margin account, it would be significantly cheaper, I believe. But for a cash account, $9,800, $370, well, $360 in the max profit. And we're talking about a market staying below 4,800. Yes, liquidity directly affects the bid-ask spread. And so just the very nature of the fact that it has people that traded it today as opposed to the MES, then it has a slightly better bid-ask, but not by much. I mean, we're talking like comparing, a Volkswagen to a pedal bicycle. It's a little bit better, but not by much. It'll get you there if you roll downhill off of a really steep hill. It's not much better. Little bit goes a long ways. So on the other account, the margin was there. This account does not have any margin. If I was to sell, I keep doing that. If I was to sell the 8,000 strike here, the buying power is around $1,000. On my margin account, I believe it was less than $600. All right, so it's a little higher on the cash account or on the retirement account, but it still can be done and it's not extreme values. It's not like trying to sell a put on SPY. In a cash account, a put on SPY, you're looking at, $40,000. I want to get a little closer because that only had $35. So here's the 4,700 contract, 101 days out for $68. That means I wouldn't have to hold it all the way to expiration to see my 50, because $50 is our goal. But I would need to hold it longer than 50%. If you want to get closer so that you can aim for the 50%, then you want to try to aim the max profit of this trade. And that would be 46.40. We're basically drawing a line in the sand here that says, do you think price could stay below 46.40 between now and the next 100 days? I don't think we're asking for too much. In the discussion for why do you think we could get challenged? What would cause us to rally like that? Well, it wouldn't be a pattern, right? It's not like we're looking at this and we're like, oh yeah, it's a descending wedge. We're going to get a pop to the up. No. The only thing that's going to drive this market to an upside breakout will be something in the fundamentals, something from the Fed, say an end of the war in Ukraine, something with energy prices, China opening, something like that, right? It won't be something in the candles where you've got some kind of trend line breakover with a head and shoulders inverted and a descending channel, none of that junk. And I say it's junk because that's the last thing that we would look at, not the first thing that we would look at. So do you believe that we could stay below this pivot point that was created after the FOMC meeting back in March, 4,600? And if the answer is yes, then we would want to put on a trade like this, where we are selling something like the 46.40 and getting somewhere near $100. The bid ask is not great, right? But look at the volume. There is no volume. If you buy one of these today, you would be the one that shows up and they're like, ooh, there's one. So we're going to work the order. I don't like to sell just what it offers. I like to bump it around a little bit, see if I can get a little more. Somebody's on the ask at 21.25. So I'm going to just bump this up to 21, try to undercut them by a quarter. And they are going to warn you, hey, that mid price ain't that good. Okay, I got the message. And there's my order working, right? So I am working a September 16, 46.40 sell to open call option on the MESU series. How's that for a mouthful? Right now, that option is pricing at $19.75, and I've got a working order credit at $21. That would give us a dollar value in credit around, doesn't show us that yet. We'd actually have to go back in and look at it. So we'll just go in and try to build one. 46.40. $99, bump it up to 21 flat. Notice I changed the price. It was on the ask 21.25. I put in a new ask at 21 flat. I moved the ask, right? If I get filled at that ask price, the max profit would be $105 in credit. The buying power effect for this trade right now is $13.50. If you're in a small account, keep some cash available, because if price runs at us, and it doesn't even have to get above 4,300, if price runs at us, the price of this option is going to go up. It's going to swell in value. We're not going to want to close this thing down. We're going to want to manage the trade. Now, if you look right now, there's nowhere to go. We can't roll anywhere because there's nowhere to go to. We will have somewhere to go soon. The M's are going to close in 10 days, and we will then be in the U series, and they will put out a series behind the U's, and we will be able to roll to the U, to that series if needed. And I can never remember the series, so I'm not even going to try. It's the Z series, right? So there is somewhere to go in about 10 days. We just have to wait to get there. The break even on this trade is basically the put or the call that we're selling. So 46.40, but that, I mean, that's like a generic answer. That's not a really great, honest, fair, solid answer. 46.40 is way up there. And as long as the S&P stays below that line, we're going to be winners at expiration. And we're not looking to hold it to expiration either. All right, any questions? See, I told you guys, short, simple, sweet, easy, no problems. Trading options on futures is something that a lot of people walk away from. They see that strange dollar value and they just throw up their hands and say, forget it, man, I don't want it. But it's just a tick value, right? So the MES is a $5 tick. If you get the calculator out and you look at $21 and you multiply it by a $5 tick, you get 105. So that's how you can figure out what your actual real credit is. So don't let these numbers kind of freak you out, right? They're not some arbitrary thing. Why I appreciate that, Ford. Once I left my day job and I was home trading for a living, this is what I had to do. You know, it's I had nothing else to do on a day-to-day basis, but learn to do new things. And of course, the more things you learn how to do, the more choices you have, you know? So it is work though. Just like anything else. All right, guys, that is the trade. I will let you know if I get filled. It will be posted. If I get filled, it'll end up in the alerts channel. If you have any, you know, later on, if you're thinking it through and you got questions, just hit me up in the chat. I'm there anyways. And otherwise, I'll see y'all tomorrow.